What if I told you that a group of criminals sailing around the Caribbean in the 1600s accidentally created one of the most innovative economic systems in history? A system that included worker compensation, disability insurance, democratic governance, and profit sharing, all while the civilized world was still operating on feudalism and monarchy. Pirates didn't just steal money, they revolutionized how money, risk, and power could work. To understand this economic phenomenon, we need to go back to the late 1600s and early 1700s, the golden age of piracy. But forget treasure chests and sword fights. This was a massive economic disruption. European powers like Spain were extracting enormous wealth from the Americas. We're talking about literal tons of gold and silver flowing back to Europe. This created the world's first truly global trade routes, but also massive inequality. The Spanish treasure fleets were essentially floating banks, carrying what would be billions in today's currency across dangerous waters. Meanwhile, legitimate sailors were working under brutal conditions for terrible pay. If you were a merchant sailor, you were basically a contract worker with zero job security, no benefits, terrible working conditions, and your boss, the ship captain, had absolute power over your life and death. Your only payment was a small fixed wage, regardless of how profitable the voyage was. This created a classic market inefficiency, massive wealth flowing through a system, but terrible incentive structures for the people doing the actual work. Pirates built something entirely different, a sophisticated business model that solved multiple economic problems at once. Unlike merchant ships where the captain owned everything and crew got fixed wages, pirate ships operated on profit sharing. Every crew member was essentially a shareholder in the enterprise, where different roles got different portions of any treasure captured. A typical share structure might look like this. The captain got 2 shares, the quartermaster got 1.5 shares, skilled positions like the navigator or gunner got 1.25 shares, and regular crew members got 1 share each. This meant everyone had skin in the game, literally equity in the business. Imagine losing an arm on the job and your boss just shrugging. That was life for regular sailors. Pirates, though, they built one of history's first injury compensation systems. Right arm gone. 600 pieces of 8. Left arm or a leg, 500. Even an eye had a price, 100 pieces. This wasn't just charity, it was brilliant economic policy. By providing disability insurance, they reduced the catastrophic financial risk that kept many people from joining high-risk ventures. It's the same logic that drives modern venture capital. You need to manage downside risk to attract talent and capital. While European ships operated as absolute monarchies with captains having unlimited power, pirate ships were democracies. Major decisions, like which targets to attack or whether to keep a captured ship, were put to a vote. The captain was elected and could be removed by majority vote. Imagine firing a CEO mid-battle. This system solved a fundamental problem. When leaders have absolute power, but don't bear all the consequences of their decisions, they make bad choices. By making captains accountable to their crews, pirates aligned incentives much better than traditional merchant or military vessels. But accountability was just the beginning. They formalized everything. Picture this. You're signing up to join a pirate crew, and they hand you a contract. Not a hastily scribbled note, but a detailed legal document called articles that laid out exactly how profits would be split, what the rules were, and how disputes would be settled. Think of it as a corporate employee handbook meets startup equity agreement, centuries before either existed. This level of organization extended far beyond their internal structure. These weren't just opportunistic raiders sailing around hoping to get lucky. Pirates built sophisticated intelligence networks, with informants in every major port feeding them cargo manifests, shipping schedules, and trade route information. They were essentially running a data-driven approach to piracy, systematically finding valuable cargo on poorly defended ships. The most successful pirate operations were basically floating conglomerates. One day they'd capture a merchant vessel, the next, they'd be ransoming wealthy passengers, then selling stolen cargo on black markets, and sometimes, when it suited them, They'd even legitimately trade with colonial settlements that were desperate for goods thanks to Europe's restrictive trade monopolies. They were running diversified business models that wouldn't look out of place in a modern corporate strategy presentation. But like most economic systems, this one had a fundamental vulnerability that would eventually catch up with it. The pirate economy's biggest strength was also its fatal weakness. It was entirely dependent on parasitic value extraction. Pirates created incredible internal equity and governance structures, but they weren't creating any actual value. They were just redistributing wealth that others had created. This worked brilliantly, as long as there was plenty of wealth flowing through vulnerable trade routes. But by the 1720s, the market conditions that made piracy profitable began to change rapidly. First, European powers started dramatically increasing security. They deployed naval patrols, created convoy systems, and fortified ports. This is the market responding to inefficiency. When there's easy money to be made, competition and defensive measures inevitably emerge. Second, and more importantly, governments started issuing pardons to pirates who would give up the lifestyle and settle down as legitimate colonists. This drained talent from pirate crews, essentially a hostile takeover of their human capital. By 1730, the golden age of piracy was essentially over. Not because pirates were militarily defeated, but because their business model became economically unviable. The financial innovations that pirates pioneered 300 years ago didn't disappear with them. They're showing up again in modern business, especially in tech startups and the crypto world. Take equity compensation, for example. Silicon Valley runs on the same basic principle as pirate ships. Everyone from founders to early employees gets equity shares, aligning everyone's incentives with the company's success. Just like pirates, modern startups use equity to attract talent when they can't compete on salary with established companies. Then there are decentralized autonomous organizations, or DAOs, in the crypto space. Token holders vote on major decisions. Leadership can be changed by community consensus, and profits are distributed based on stake in the organization. It's essentially the pirate model, but with blockchain instead of cannons. The gig economy follows similar patterns. Uber drivers, DoorDash delivery workers, and freelance contractors all bear entrepreneurial risk in exchange for potential upside, just like pirate crew members. Though unfortunately, modern gig work often lacks the comprehensive risk-sharing and democratic governance that pirates provided. Even venture capital mirrors pirate economics. VC firms pool resources from investors like pirate crews pooling their efforts. They seek high-risk, high-reward opportunities like attacking treasure ships and distribute profits based on predetermined share structures. But there's a darker parallel too. Just like piracy, some modern disruptive business models are essentially sophisticated forms of value extraction rather than value creation. Think about companies that achieve profitability primarily by avoiding taxes, exploiting regulatory gaps, or externalizing costs onto society. They might be innovative in their methods, but they're ultimately parasitic on existing value rather than creating new value. Pirates created an advanced system for distributing wealth and managing risk within their organizations. But they failed at the most fundamental business challenge, creating sustainable value proposition in a changing market. In the end, they became incredibly good at dividing up the pie, but they never figured out how to grow it. Modern businesses face the same fundamental choice. You can build a company that's essentially extractive, finding ways to capture value that already exists in the market through superior execution. Or you can build a company that's genuinely creative, finding ways to create new value that didn't exist before. Extractive strategies can be incredibly profitable in the short term, especially if you're early to identify and exploit an inefficiency. But they're vulnerable to the same forces that destroyed pirate economics. Competitors will copy your methods, regulations will close the loopholes you're exploiting, and the inefficiencies you depend on will eventually be corrected by market forces. Creative strategies are harder to execute and often less immediately profitable, but they're much more defensible in the long run. So what can we learn from the rise and fall of pirate economics? First, organizational innovation can be just as important as product or technological innovation. Pirates didn't invent better ships or weapons. They invented better ways to organize people, align incentives, and share both risks and rewards. Many of their governance and compensation innovations were centuries ahead of their time. Second, you can have the most advanced internal systems in the world, but if your fundamental business model isn't sustainable, you're still vulnerable to disruption. In today's economy, we're seeing this play out everywhere. The most successful companies are those that have figured out how to combine pirate-style organizational innovations with sustainable value creation rather than mere value extraction. Whether you're thinking about joining a startup, investing in crypto projects, or just trying to understand how modern businesses work, the pirate economy offers a fascinating case study in both the power and the limits of organizational innovation. Pirates accidentally discovered that you could build more equitable, more democratic, and more innovative organizations than anything the established powers of their time had created. But they also discovered that innovation without sustainability is just a very exciting way to fail. And that might be the most valuable financial lesson of all. In the long run, the organizations that survive and thrive are those that can innovate, not just in how they distribute wealth, but in how they create it in the first place. The real question is, how many of today's unicorns are just pirate ships in disguise?